Hello everyone, and welcome back to Trading Club Q7U. Today, we're going to dive into the crucial aspects of building a solid trading strategy, something that will make all the difference between success and failure in the markets. Now, as traders, we often get caught up in the excitement of the market, focusing too much on technical analysis, chart patterns, or trying to predict what the future holds. But that's not what it's all about. Today, we're going to strip away all the noise and focus on the fundamentals. We're going to talk about something called entry triggers, invalidation levels, targets, and management, which will form the backbone of your trading strategy. Let's start by defining each of these terms. An entry trigger is essentially the reason you decide to enter a trade. This is like a set of traffic lights. When the light turns green, you can proceed. But, just like a traffic light has a corresponding red light, you need to define why the trade is invalid, or to put it another way, why the trade is a bad idea. Think of this as the exit sign, where you need to stop and reassess. Targets, on the other hand, refer to the price levels where you aim to close the trade, making a profit. This could be a simple moving average, an area of support, or even a chart pattern. The idea is to find a price level where you can close the trade with a profit. Now, management refers to the process of constantly monitoring and adjusting your trade as it unfolds. This is like driving through the night, where you need to stay alert and make the right turns to reach your destination on time. Trading is the same. You need to stay focused, monitor your trades closely, and adjust your stop loss or close the trade if market conditions change. Let's use a practical example to illustrate these concepts. Suppose we're trading the euros on a demo chart, and we decide our entry trigger is a break above 1.10. This means that, if the price touches and holds above 1.10, we could consider entering a long position. However, if the price reverses and drops back below 1.095, our invalidation level, we would close the trade quickly. Our target might be 1.115, where we could lock in a nice profit. But, as the trade plays out, we need to be prepared to adjust our stop loss, or even close the trade, if market conditions change. This is where trading management comes in. Now, let's talk about some common beginner mistakes that you should avoid. These include not defining your entry triggers and invalidation levels clearly, and failing to adjust your targets or stop losses as the market moves. New traders often get caught up in the excitement of the trade, only to find themselves stuck with a losing position. This can lead to trading psychology issues, and even cause you to give up on trading altogether. To avoid these mistakes, you need to prioritize clear planning and discipline. Define your entry triggers, invalidation levels, targets, and management clearly, and stick to your plan like your life depends on it. Remember, trading is not a lottery, it's a business, and you need to approach it with a solid plan and a clear understanding of the risks involved. Now, let's move on to your practical homework exercise. Open your demo chart or paper trading journal and choose a popular stock or index, such as Apple or the S&P 500. Define your entry trigger, which could be a break above a certain price level or a momentum indicator. Next, determine your invalidation level, which is the price level where you would close the trade quickly. For example, let's say you're looking to buy Apple, and you think that a break above 150 per share is a good entry trigger. However, if Apple drops to 135, that could be your invalidation level, where you'd close the trade quickly. Now, determine your target, which would be the price level where you aim to close the trade making a profit. This could be 160 per share, depending on your stop loss and the profit you aim to make. Finally, practice managing your trade in a simulated environment, adjusting your stop loss and target as needed. Don't forget to stay alert, just like driving through the night, and adjust your trade according to market conditions. Here's an example of how your homework exercise might look. Remember, this is just a simulation, and never risk real capital without proper training. Always practice on a demo account or paper trade before risking real money. In conclusion, today we've learned the essential components of a